Yeah, I think it's recording now. Okay, so I think I should start the lecture. Okay, so I'm going to present my screen again. Okay, all right. So I think it's high time to start. Already 17 minutes have gone. So good morning and welcome again to all of you. We are starting our online classes. This is the first lecture, Money and Banking. Already we have done a little bit of this chapter, if you remember. If you recall, before going to the lockdown, we already had done a little bit, and that's the part that I'm going to just very quickly go over. Okay, there's no need for me to explain everything. Everything is already given. You already have it in your notebooks. And also, there's also a part on that on the note that I gave you, okay, which was in the note also I have. Let me show you which note I'm talking about. Um, the note that is, I think, here, this one. I think all of you have this one also. This is something that I already uploaded long ago. Okay, so most things are from here. I've just presented them in the slides like this. Okay, so first let's quickly go over this. What is money? So if you remember in the class, money is something that you can use to pay for goods and services, or also for repayment of loans. So it's a commonly accepted material, good or service, or not service, usually it's a good or a thing, product, item that you can use for paying for goods and services and for the repayment of loans, as you can see here. And what is the role of money? We have discussed this also, that it's a medium of exchange. It has a unit of account and a store of value. We have discussed all three in detail, so I'm not going to go over this now. You can just read the notes, the class notes that you have, or even the file that I have given you before. And we have also done this, I remember, the types of money. Commodity money, such as gold, silver, bronze, commodity backed money. So this is basically a type of a check. Then fiat money is basically the currency that we use now, fiat money, paper money. There's bank money, electronic payment, and e-money. So e-money is basically your cards, okay? So your debit cards and things like that. However, if you remember that credit card is not money, okay? Why credit card is not money? Although yes, commonly it's called plastic money, but it's just a term, okay? Plastic money. In under economics, we cannot call it money. Why? Because the thing is that credit card is sort of a loan that you take from the bank, right? So if it is a loan, there is no store of value, because that's not something that you already own. Okay, that money has no value because there is actually no money. It's just loan that you're taking from the bank, which you have to pay back later. Okay, so it's not really a money. And you can also read that part that's in this uh, the file that I gave you, the document that I gave you. So you will have it here. See, so is credit card money? The answer is no. The answer may come as a bit of a surprise, but recall, to be money, it has to be able to store value. Okay, so remember this thing is there here. And there are some interesting things that I highlighted here to show you the different types of monies that have been used. So look here, candy bars, cigarettes. I hope you can see this. Candy bars, cigarettes, huge wheels of carved stone, cowrie shells, beads, cattle. Okay, these have been used before as money, but you all can understand this is commodity money because these had other uses also, and not just for using as for exchange. Okay, then I remember telling this to you. Prisoners usually made purchases with cigarettes. I also said about ramen noodles, okay, which is basically a type of Maggi noodles that we have. These are also used in the prisons. There's one more interesting item that I have given here. Dolphin teeth as currency. Okay, so here in Solomon Islands, okay, these are some islands in the Pacific Ocean. In this island, they use dolphin teeth as money. Okay, and there's also, you can see I've highlighted some here, some interesting examples here. Curled pig tusks. Okay, in this neighboring uh, islands, they also use that. Whale teeth is also used. Okay, so dolphin teeth is used in some places. Whale teeth is used in some places. Then sometimes they try to use fruit bat teeth. So bat teeth. Okay, they use this. It's actually a fake type of currency. They try to do it, but still they sometimes use it. So you can see so many types of items were used, commodities can be used as money, and they are being used also, or they have been used in the past. Okay, let's go back to the slides that I prepared for you. So here we discussed these in class, so let's move on to the next part. Okay, so this is the first solved question. I hope you can see, but let me still zoom in a little bit. Which type of money is being used here? So I've given some situations, some 4 situations, A, B, C, D. You have to, this is slide number 4, okay? So you will have to identify which type of money this is from among the 6 or 7 type of money that you have learned. The number 1, bottles of rum that were used to pay for goods in colonial Australia. So rum is an alcoholic drink. So bottles of rum were used to pay for goods and services. So bottles of rum, what type of money are they? So I think it's very clear. It's a commodity money. The answer is also given here. It's a commodity money, since the rum has other uses as well. Not only for drinking, but also, you can use it as antiseptic. Okay. Okay. Part B. Salt. Salt was used in many European countries as a medium of exchange. So salt, again, think about it. Salt is a commodity money, right? Because salt can be also used in other purposes also, not just for using in exchange. Okay, at this point I want to say to you, if any of you have any question, you can please definitely speak up. Okay, don't write in the message box yet, because I cannot see the message. Okay, because I can only see the slides. I cannot see if you are writing any questions in the chat box. So if I'm presenting, you have any question, I would really like you to actually speak up and say that, okay, this is the problem I'm facing. Okay. Okay, and let's look at the part C. For a brief time, Germany used paper money, the rye mark, that could be redeemed for a certain amount of rye, which is a type of grain. So rye, this RYE, is a type of grain, okay, just like wheat and other types of grains that we know. Before, in Germany, they used to use something called rye mark, okay, which was something that if you would have that paper, you could go to someone and you could just exchange that paper for a certain amount of rye. So can you, I think you can imagine, it's also there on the screen, but also this is commodity backed money, right? Because commodity backed money, remember, if you remember what I said in class, that it is just a useless piece of paper, but in the paper is written that if you give to me, I will give you this amount of that item. Okay, so that means here this rye mark, okay, this is a commodity money. Okay, I hope it's clear. We have done all this. I don't think you should have problem in understanding these answers. In the town of Ithaca, New York, prints its own currency, the Ithaca hours, which can be used to purchase local goods and services. So what type of money is this? It is fiat money here. Because not, why is it not commodity money? Because for commodity money, you need some commodity to be, it's commodity backed money. This means what? That means there is some commodity that is supporting the value of this item. So this note, Ithaca hours, this has nothing, no sort of item, no sort of commodity like gold or some any other item that is, supporting it. It is just a piece of paper which everyone agrees that, okay, we can use this for currency. Okay, which is exactly what now we have. the type of notes and currencies we use right now. Okay, there is no gold that is supporting this 10 taka or extra taka that we use. Okay, similarly here also, only in Ithaca, okay, only in that town, all of them are using this new currency, the Ithaca hours, which is all of them are agreeing that okay, we'll use this for exchanging goods and services. Okay, so this is a type of fiat money here. I hope this is clear, that how we are able to identify what type of money we are talking about. Okay, so let's move on to this. I think we have also done this. Can you let me know? Have we done M1 and M2? I can
Yes,
remember.
ma'am.
Okay, so we have done that also, but let's quickly go through that. Narrow money or M1. What is this? This is consist of two parts. Currency in circulation, that means all the notes and coins, whichever is circulating in the economy. Okay, that is, it's not there in the banks, it's there in the hands of the people. Okay, so that is currency in circulation. Plus demand deposits, which I think how did I write that in the class? Did I call it demand deposits or something else? Checkable accounts, I think, or checkable deposits, maybe I mentioned in class. Same thing. It's the same thing, okay? It's all those accounts that you can easily convert to cash. You can easily dissolve the account and you can just take out cash. Okay, so all of those are there. So demand deposits include current account. So current account, basically those accounts in which the money is usually stored, but it usually doesn't have any sort of interest. There are some savings account where there is some interest, you can save money and you can have interest. And traveler's check is something very strange. Traveler's check is actually a sort of a check, okay, which foreigners can have in your country. So suppose in Bangladesh, if there is some American, he or she can actually carry a traveler's check, which is sort of like money. Okay, it's issued by special banks. That is, instead of carrying the taka, they can carry traveler's check and they can use that for paying for goods and services. In Bangladesh, it is not really that popular. Okay, actually in the world it's no longer popular. It used to be popular before, but now since it's so easy, to buy foreign currency, now really no one bothers about traveler's check. Okay, so even we will not bother about it. Let's move to the next part. Broad money. So broad money, again we spoke about this, it is narrow money, so M1 plus something they have mentioned, quasi money, but it's okay, you don't need to know the name quasi. It's basically all the time and savings deposits in the banks. We have spoken about this, and also the foreign currency deposit that are there, all those we add them up and we'll have something called broad money. So we have spoken about this. Does M2 includes everything in M1 and additionally includes the savings deposits, time deposits and foreign currency deposits. Okay, so long term. So the long term deposits or long term accounts that people have, okay, all of these fall under M2. We have done this, so let's go to this one. Question number 2, solve question 2. For each of the following transactions, what is the initial effect on M1 and M2? So what you have to do is, if you have to look at the three given options here, and you have to say what is the effect on M1 and effect on M2. So let's look at the first one. You sell a few shares of stock and put the proceedings into your savings account. So stock, basically share, okay, you have some share, suppose, and you sell them and you put whatever money you get into your savings account. So can you tell me, in the economy, what will happen to M1, what will happen to M2? So let's read. Shares of stock are not a component of either M1 or M2, right? So holding fewer shares does not decrease either M1 or M2. However, depositing the money into your savings account increases M2. Increases M2, since the savings accounts are part of M2 but not part of M1. M1 does not change. Okay, let me make it clear here. Savings account in the okay, this might be a source of confusion to you. There are two types of savings, what should I say, accounts. Number one is savings account, another is savings deposit. How are they different, right? Savings account is basically those, checkable deposit accounts, okay, which do earn some interest, but you can easily break it and take out the cash, okay, which is basically part of M1. But savings deposits, it means those long term deposits, the one that people make for 5 years, 10 years, 8 years, okay. um, so I would like to differentiate both of the, since both are savings accounts, but to differentiate the two types from now on. Okay, I'm going to say savings account basically means those short term accounts, okay, and savings deposits mean those long term accounts. So savings account will be part of M1, but savings deposit will be part of M2. Okay. Now the thing is, in this book, because this is actually snapshot of the book's question. Unfortunately, here they mean savings deposit, but they wrote savings account. Okay, that's why it is said here that M1 does not change. Okay, so please be clear about this. Make sure you keep a note on this, that from now on, when I write about this, I'll make sure that savings account means, so as you can see, even if you go to the previous one, see, so savings account is given in narrow money. From now on, I'll follow this rule that savings account is part of the narrow money. Okay, but savings deposit, so look, savings deposit is actually the long term deposits. Okay, so make sure that you don't get confused when you see these numbers, these names. So here in this word account, it should have been savings deposits. Okay, so if you want, you can cross this and you can write deposits here. Okay, so I hope it's clear. Let's move to the next part. You sell a few shares of stock, part B, and put the proceeds into your checking account. Checking account, what does this mean? Checking account is basically, remember in the M1 we did the checkable deposits, the short-term accounts, the current accounts, the savings account, those things. So that is what they're talking about. So if you sell,
ম্যাম একটা
yes,
কোশ্চেন
yes, sure,
ম্যাম এ নাম্বার যে কোশ্চেনটা ওখানে কি তাহলে সেভিংস
deposits,
ডিপোজিট হবে
yeah,
আচ্ছা
yeah, exactly. So make a note, okay, in your notebook, just write it down. The solved question 2 part A should be savings deposit, not saving account. So when you study, you can sort of remember that you had to check this. Okay, is it clear, Mashfi?
ইয়েস ম্যাম
Okay, okay, so now part B, you sell a few shares of stock and put the proceeds into your checking account. Okay, so what's the effect? Let's see. Shares of stock are not a component of either M1 or M2, and so holding fewer shares does not decrease either M1 or M2. However, depositing the money into your checking account increases M1. Since checking accounts are part of M1, it also increases M2 since M1 is part of M2. So this is very clear, okay, because they said that you are going to share the stock of the share of stock, and you are putting the money that you get back into your checking account. Now remember, checking account is part of M1, so obviously M1 will increase. But at the same time, M2 will also increase. Why? Because remember, M2 is M1 plus the remaining. So if M1 increases, naturally M2 will also increase. Okay, so both M1 and M2 will increase. This is the answer of this question. Both M1 and M2 will increase. Okay. Now, if
ম্যাম
you look, yes.
চেকিং অ্যাকাউন্টটা কি ওটা একটু আরেকবার বলবেন?
Okay, checking account is, if you look here, it's basically here. Demand deposits. Demand deposits is also called checking account. Okay, or you can actually say checking account, or you can say current account, same thing. Okay, so do you understand current account? Current account is basically an account in the bank where you can just go and deposit money. It usually has very negligible or zero interest. So when you deposit the money there, it won't really earn any interest. Okay, it's just a way of storing money, saving money. Okay, so ওইটাই হলো checking account. So if you sort of save money there, if you keep the money there, your M1, the M1 of the economy will increase. Okay, as well as the M2 will also increase, because look at the equation here. M2 is equal to M1 plus the other things, that is other things both as in time deposits,
Okay.
savings deposit, all those things. Okay, so if this
Okay.
increases, so if this one increases, this will also increase, because remember this
This
is,
is QM.
sorry.
What this QM? Quasi money or something?
Okay, quasi money is basically these things: time, savings deposits, and foreign currency deposits. So these together is called quasi money. Don't bother. I won't really bother about quasi money. Just remember the distinction: narrow money and broad money. Okay, you don't need to understand what quasi money is separately, but what it means is this: that all the time deposits, so basically these things, look, these things are quasi money: saving deposit plus time deposit plus foreign currency deposits, all these things include, these are all quasi money. Is that clear what quasi money is?
Yes, ma'am. Okay.
Okay. Okay, and then look at the last question here. You transfer money from your savings account to, sorry, it keeps going away. You transfer money from your savings account to your checking account. Now again there's a mistake here. um, mm, okay, there's another mistake here. This should probably be savings deposit again. Okay, so make sure in part C you correct this. It should be savings deposit. So account, cut this word account and you write here deposit. So you transfer money from your savings deposit to your checking account. So let's see what's going to happen. Moving money from savings to checking has no effect on M2, since both saving deposits and checking accounts are included in M2. However, since savings accounts are not, okay, just give me one moment. I'll be back. Okay, just a few seconds. Okay. So can you see the screen now? Can you see the screen?
Yes, ma'am.
Okay.
Yes, ma'am.
Sorry, I had to go. So, okay. So part C, moving money from savings to checking has no effect on M2, since both savings accounts and checking accounts are included in M2. However, since savings accounts are not part of M1, so here remember, savings account doesn't mean saving account, here it means saving deposits. However, since savings deposits are not part of M1, moving money from savings to checking does increase M1. So here try to understand. So you have some money in your savings deposit, okay? You're moving that money to your checking account or your current account, same thing. So what will happen here is your M1 will increase, Because remember, savings deposit is not considered in M1, right? It's considered in M2. But you are changing that and you are bringing it to your current account. So your M1 will increase. But now the question is, what will happen to M2? The answer is there is no effect on M2. It will not change. It will neither increase nor decrease. Why? Because you are basically just moving one form of money to another form of money in M2. It was first savings deposit, now it is just part of current account or checking account. So there's not much change, right? There's no change. Therefore, there is no effect on M2. Okay, is that clear? So please do let me know if you are not
Yes, ma'am.
following.
Clear.
Okay, if you're not following, let me know. Okay, this is basically a regular class. If you don't speak up here, then I will never know if you have any problem. And if I don't clear it now, you will never be able to clear it later. Okay, so please do let me know if you have a problem. Okay, so let us move on now to the next portion, which is basically what we are supposed to start actually today. Already 45 minutes have gone. I hope we can finish this or at least do a lot of this. So let's start from the next slide. This is slide number 8. Okay, this is slide number 8. Here we are actually, have we done these things? Required reserve and all these things? I don't think so. Okay.
No, ma'am.
Okay,
No,
so
ma'am.
this is actually new content. Okay, so all of you please listen carefully. What we are going, this is basically the last part. Okay, this is the last part of this chapter. Creation of money. Now the thing is that you must be thinking, who can create money, right? Who creates money? The answer is the central bank of a country usually prints the money. So the central bank of Bangladesh is called Bangladesh Bank. Okay, so Bangladesh Bank has the authority to print money in Bangladesh. But then I wrote here the creation of money. You should know that the other commercial banks, the commercial banks of Bangladesh, okay, they are not allowed to print any money. Only the central bank of the country is allowed to print money. Okay, but here what we are going to see is that new notes will not be created, but money use will increase. So that's why it's actually called creation of money. So once we read, you'll understand what's happening. But before we go directly into the creation of money, some things we need to understand. So let's read from the whatever written on the screen. Many banks have an account with the Federal Reserve. Now this is the American book. So all these material that you see in the PPF, sorry, not PPF, the PowerPoint slides, most of these are usually snapshots of the books that we are following. Okay, so the Paul Krugman book, then you have the Bangladesh book. So I've just taken some pages from those. So those are all American books. Everything that you see here is American. Okay, but we are going to look at this from the Bangladesh perspective. So here Bangladesh Bank is the central bank of Bangladesh. Okay, so many banks have accounts with the central bank of any country. So the banks that we have, okay, all the commercial banks, BRAC Bank, then EBL Bank, okay, Bank Asia, whatever bank you can think of, they all have accounts with the central bank of Bangladesh. That means Bangladesh Bank. This account is very similar to the checking account or the current account that normal people have in commercial banks. Okay. Now the thing is, banks also have currency or cash in their vaults. Okay, which is here called vault cash. Okay, on the bank premises. So suppose that there is a bank called Bank A. Okay, let's just take an example. There is a new bank called Bank A. Now, what does the bank have to do? The bank has to open an account with Bangladesh Bank. Okay, as I've told you before, it has to have an account with Bangladesh Bank. At the same time, it will also have some money in its vault. Okay, vault, that means this number, this name, VAULT. It has to have money in its vault. Vault is basically a sort of like a storage room, okay, or a storage unit. So there is some money in its vault, which is called vault cash. The sum of bank deposits at the Bangladesh Bank or the central bank, whichever you want to say, and the bank's vault cash is known as reserves. So this is very important. Reserves is what? Reserves is all the money that is kept in the account with the central bank plus the money that the bank stores in its vault. Okay, so I'm repeating. Reserves are all the money that is kept in the account with the central bank plus the vault cash. So suppose if I ask you, what is the reserves of bank A? How much is the money that is there that you can call reserve of bank A? You will say the amount of money that the bank A has deposited in the account with the central bank plus the money that this bank has in its vault. If you add these two, you will get the reserve that this bank holds. Okay, so every individual bank has some reserves. And how can you find the total reserves? You calculate the total bank deposits at the central bank plus the vault cash. Okay, is this part clear? What reserves are? I
Yes,
hope it
ma'am.
is clear. If it is not clear, please do let me know. Okay. Okay, so let's move on to the next paragraph. The required reserve ratio and the required reserves. Now the thing is, the central bank, okay, asks these commercial banks to keep in the bank deposits a certain fraction of their checkable deposits. Now, what do I mean by checkable deposits? So try to understand that what is the usual work of banks. Banks usually accept some money from the depositors, they keep it with them, and if someone wants to take loan, the bank gives that money to the person, and then it takes the interest and returns the money back to the original person. This is the overall work of a bank. I hope you all are familiar, you understand this. Okay, now the thing is, how much money, that's the next question. So if you can understand, bank deposits with the central bank, the question is how much money should be there in this account. Okay, should it be all the money, should it be some money, how, what is the rule? The rule is this: every central bank in the world, so Bangladesh bank, then even the Fed in the US, or whichever central bank, they always have a ratio. They always fix an amount of ratio that they say that this is the amount of money that you should deposit to us in the bank, okay, in our account. Okay, so they usually decide a fraction. So for example, suppose Bangladesh bank says that from now on you have to submit 40% of all the money that you get deposited in your bank with the central bank. And suppose that bank A has 100 taka. Okay, bank A has 100 taka as its checkable deposits. So suppose that there are two people, they have all submitted 50 taka to this bank. Okay, so now the total amount of money that the bank A has is 100 taka, right? So how much money should this bank A keep with the central bank here if the amount is 40%? So 40%. So 100 এ 40. So that means 40 taka. 40 taka has to be submitted to the central bank in its account. Okay. And how much money is left as vault cash? Can you say? So from 100 taka, 40 taka has already been given to the
60.
central bank. So remaining 60 taka is now the vault cash. Okay. So that is the whole idea. Let's go to the next slide. Now, the fraction of checkable deposits or current account that checkable, let's call it checkable deposits, the fraction of checkable deposits that banks must hold in reserve form is called the required reserve ratio. So remember I told you 40%, so 40% is the required reserve ratio. In Bangladesh we say CRR, okay, choto hate small CRR. So this amount is basically the percentage. Usually it's in percentage form. So 40% or 10% or 5%, something like that. So all the central banks in the world, they usually already find out an amount of the reserve ratio, and it's imposed on every bank in the country. Okay, so all the banks that are there in Bangladesh, they all have to follow this, that all of them have to reserve this amount of money in the Bangladesh bank. Okay, and that is technically called required reserve ratio. And let's go directly to the formula. So you can see required reserves is equal to R. So here in this book they mean R, they mean as in the required reserve ratio. Usually what I do is I usually say this is CRR. Okay, in Bangladesh we like to call this CRR, cash required reserve. Cash required reserve, I think that's what in Bangladesh we like to call. It's the same thing. CRR and R is the same thing. Okay, so required reserves is CRR into checkable deposits. So as an example, look, an example is given here. Assume that customers have deposited 40 million in a bank, and that the Fed, so here Fed is basically the American Central Bank, has set the required reserve ratio at 1 by 10 or 10%. Okay, so 10% is the required reserve ratio that the bank has imposed on the commercial bank. The required reserves for the bank then equals 4 million. How did this 4 million come? 0.1 into 40 million is 4 million. So remember something, this formula is important. If I ask you to calculate the required reserves, you first need to know what is the CRR or what is the R. Okay, what is the required reserve? And you have to multiply that with the total amount of money that is deposited in the bank. So in this example, total 40 million was deposited in the bank, and you multiply that with the CRR that is already given, which is 10% or 0.1, and then you get your 4 million. Is that clear? I hope this is clear.
Yes, ma'am.
Okay.
Yes, ma'am.
Next, let's move on to the next part, which is called excess reserves. What is excess reserve? So remember I told you in the previous slide here. So reserves, total reserves is what? The amount of money that the commercial bank deposits to the central bank, which is basically required reserves. Now you know the term required reserves, plus some vault cash. That means the extra money that it has in the vault. Now where does this extra money come from? That extra money is actually nothing but excess reserves. So a example dekhi suppose. So 40 million taka is there in the bank. From there 4 million it is giving away to the Bangladesh bank, right? So how much money is left in this bank? So 40 million minus 4 million. So 36 million. So 36 million is the excess reserves. So as you can see, the formula is given here. The excess reserves is equal to total reserves minus required reserves. So how much ever total money you have here minus the required reserves. Okay. Okay. So I hope this is clear. Okay, wait, let's see. What's 36 or is it something else? Wait. Let me check. Oh, okay. Okay, wait. Not 36, because here I didn't mention. 40 million is actually the checkable deposit. This is not the total reserves, right? This is not the total reserve, because here there is another question that the bank will not just keep this 40 million, right? It will also loan out. So that's why they have just said example. For example, if the bank's total reserves are 5 million, I mean, they have given this value, okay, you didn't figure this out. They already gave this value. Suppose that total bank reserve is 5 million. And we have calculated just now that the required reserves is 4 million. So that means how much money is left as excess reserve? 1 million. Okay, 1 million taka is remaining as excess reserves. Is this part clear?
Yes, ma'am.
Okay. So now let us move on to the next slide, which is important here. This is, let's go back. Okay. So here we are looking at a little bit Now here is the part actually where we are going to learn that how the banking system creates money, or money expansion or money creation, same thing. Okay, now we are actually going to see how money is really created in banks. So let's read this part here. Banks in the banking system are prohibited from printing their own money. Prohibited means not allowed. So banks are not allowed to print their own money. Okay. Nevertheless, the banking system can create money by increasing checkable deposits. So let us see. Let us see what's going to happen. The process starts with the Fed. So remember, Fed here is basically the central bank. So the process starts with the central bank. For hypothetical purposes, suppose that the central bank prints $1,000 new paper money and gives it to Bill. So we let's start the situation by assuming these things. Okay, assume that the central bank has created some money, and specifically $1,000, and it has given to a person called Bill. Bill takes this newly created 1,000 taka or dollar and deposits it in a bank, and let's call it bank A. Let's see, you all I think are familiar with T accounts. Okay, T accounts are just simple balance sheets that records the changes in the bank's assets and liabilities. Now assets and liabilities, again, I'm sure many of you know, if you have done, I think, finance or accounting 101, maybe if you have done, you will know assets and liabilities. So assets are usually what should I say, something that you own, okay, your own item, and liability is something that you own of someone else, so you have to pay back. So assets is your own and liabilities is what you have to pay back. Okay, so bank A, we are going to see the changes in the assets and liabilities that will happen. Okay, now because Bill has deposited this money $1,000 into bank A, let's see what change will happen. First, look at the assets part. In assets, the reserves will increase by $1,000. At the same time, liabilities, checkable deposits will also increase by $1,000. So he has made an account here, right? So that's why here we call checkable deposits or current account bolte paro, same thing. So Biller name, so in his name, in Bill's account, there is $1,000. But why is this liability? This is liability because the bank has to pay this back to Bill anytime. This is not the bank's property, this is Bill's property. But at the same time, the reserves of the bank has increased because now the bank has extra money. It has extra 1,000 taka, a dollar, right? So that's why the reserves will also increase by $1,000. Because the deposit initially is added to the vault cash, the bank's reserves have increased by 1,000. So basically what I just said. Okay, and the bank's liabilities also have increased by $1,000 because it owes Bill the 1,000 he deposited. So I hope this part is clear. This is not the end. Obviously, we are going to see how the whole money is created here. Next, the banker divides the 1,000 reserves that it has into two categories: required reserves and excess reserves. The amount of required reserves depends on the required reserve ratio imposed by the central bank. And let's say, for the sake of this example, let's say the central bank has decided it's 10%. Okay, so CRR is assumed here to be 10%. This means that the bank holds $100 in required reserves against the deposits and holds 900 in excess reserves. So this is very clear. Total money that has been deposited is $1,000. From there, 10% has to be given away to the central bank, and you can know that you can calculate it very easily. 10% of 1,000 is $100, right? So $100 is part of the required reserves, and the remaining money, that means $900, is now part of the excess reserves. Okay, now let's see what happened to the T account. Okay, because of this change, what happens to the T account? So look at the T account, look at the assets part. Okay, we can see that the required reserves is now $100 and the excess reserves is now $900. So previously we did not divide it. Previously it was just called reserves. So this is total reserves. Total reserves is $1,000. But if you go to the next slide, you will see that assets are now, so those reserves can now be divided into two parts. Required reserves is $100. Excess reserves is $900. But you see, if you total it, you will still get $1,000, right? And let's go to the liabilities part. Liabilities is the same, okay? Because you can see, okay, just everyone just give me another moment. Actually, let's do something. Let's take a break. Actually, let's take a break of 5 minutes. Okay, can you hear me?
Yes, ma'am. Okay.
Yes,
Okay,
ma'am.
let's take 5 minutes break.
Okay.
Okay.
Hello, ma'am.
হ্যালো, ইয়েস, মাশফি।
Yes, ma'am. ম্যাম ওই যে ফার্স্ট স্লাইডে যে ম্যাথটা ছিল না, 40 মিলিয়নের পরে 5 মিলিয়ন দিয়ে ওই যে রিজার্ভের ওই জায়গাটা সিআরআর দিয়ে যে পার্সেন্টেজ দিয়ে অ্যামাউন্ট বের করছিলাম।
হুম 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 জাস্ট
ম্যাম
ওয়েট আ
ওখানে হচ্ছে আমার কথা হচ্ছে পরেরটাতে কি 5 মিলিয়ন টোটাল অ্যামাউন্টের কথা বলা হয়েছে?
This one, right? This is what you're talking about, right?
ইয়েস ম্যাম।
Okay. Yes, here they are saying total reserves is 5 million. They have already given it to you. Yeah.
ইয়েস ম্যাম।
I mean, you don't have to calculate it. They have already given it to you. That 5 million is the total reserve. And you
ও
know the
আচ্ছা,
required reserve. So now
ওকে
you
ম্যাম,
have to find out the excess reserve.
বুঝতে পারছি। আমি ভাবছিলাম কি 5 মিলিয়নই মনে হয় টোটাল, ওটাকে পার্সেন্টেজ করলে তো আর 4 মিলিয়ন আসবে না, ওইটা কনফিউজড হয়ে গেছিলাম।
Okay, okay. No, that is the total reserves.
ওকে ম্যাম।
Okay.
ম্যাম আই হ্যাভ আ কোয়েশ্চেন।
Yes, sure.
তো ম্যাম রিকোয়ার্ড রিজার্ভটা কি বেসিক্যালি সেন্ট্রাল ব্যাংকে যতটুকু মানে ডিপোজিট করা হচ্ছে সেটুকুই?
হ্যাঁ, exactly.
ওকে
Exactly.
ম্যাম, ওকে
So,
ম্যাম।
so usually that amount is how much percentage. So whatever money is in the bank, in the commercial bank, so some percentage of that will have to be submitted to the central bank. Okay, and that is called the required reserves. You're right. Your answer is correct.
ওকে ম্যাম।
Okay. Any other questions so far? Okay, so let us resume. Okay, all of you are here. Okay, hopefully all of you are here. So let's continue our discussion. So I hope you remember that we saw in the previous slide that $1,000 is being created by the central bank, and it has been given to Bill, and Bill has submitted all of that money into Bank A. And thus we can see that the assets of Bank A has increased by $1,000, and the checkable deposits in Bill's name has also increased the bank's liabilities by $1,000. And also we saw that the reserves can be divided into two parts. Since there's a 10% required reserve ratio, from there $100 has to be given to the central bank as required reserves, whereas $900 is now the bank's excess reserves, right? So hence the previous T account, you can also rephrase it and write it like this. So the total in this side is also 1,000. The total in this side is also 1,000. Okay. Now let's see what they have written. On the left side or the right side of the T account, the total is 1,000, just like I mentioned previously. By dividing the total reserves into required reserves and excess reserves, okay, these excess reserves can now be used to make new loans. So look at this money, $900. This $900 is now with the bank, ready to be used, ready to be given out as loan. Okay. Now, when Bank A gives Jenny a $900 loan, so suppose now there's a new person, Jenny. She comes to the Bank A and says that I need $900 as loan. When the Bank A gives Jenny a $900 loan, it doesn't give her $900 cash. Instead, it opens a checking account for Jenny at the bank, and the balance in the account is $900. So if Jenny goes to the bank and she wants $900 as loan, instead of giving her just cash, it will open an account for her in the bank, a checking account in the bank, and it will have her name in it, and there will be $900 in that account. Okay, so if this happens, let's see what changes will happen now in the T account of the bank. So again, look at the banks. Okay, let me. Okay, so look at the banks. This is no, sorry. Okay, I'll have to. Yeah. Okay, now we can see. So look at the assets. So assets, remember, required reserves was $100. Excess reserve was 900. Remember. So look at the previous one. But at the same time, loans. Now there is a new quantity here, loans, because remember the bank has given loan to Jenny. So here the loans is now also $900. So plus 900. So you see these are the assets of the bank. These two are the previous required reserves and the excess reserves that we had. But at the same time, there's a new quantity here in the assets portion, which is loans. And this is plus 900 because it has given $900 to Jenny, right? Now let's see what change happens in the liabilities. Look at the liabilities portion. So for Bill, its checkable deposits is $1,000, but at the same time, checkable deposits for Jenny is 900, right? Because remember there is a new account there in Jenny's name, and in that account there is $900. So see, there is a total of 1900 now, and here also there is 1900. So you see, money has actually increased. But let's move to the next portion to understand it better. Is this part clear? How much we have seen so far?
Yes, ma'am.
Sure, everyone?
No, ma'am, where did bank get this extra 900?
This 900 taka is actually the excess reserve. This 900 taka is part of the 1000 taka that Bill has deposited in this bank. But why can it use 900 taka to give it to Jenny? Because from this total $1,000, only $100 has to be given away to the central bank. So the remaining 900 taka is there in its vaults. It's present in the vault in the bank. So what can the bank do with this $900? It will give a loan to the other people and gain interest from that loan. Is that clear now? So
No,
$900.
ma'am, actually 900 টা তাহলে ম্যাম হচ্ছে যদি দিয়ে দেয় তাহলে মাইনাস হয়ে যাবে না? বিকজ অ্যাসেটে তো আর থাকে না, অ্যাসেট থেকে চলে যাচ্ছে না?
If you come, let's go to the slide. Where is that? Okay. So loan. So we are talking about the one
ম্যাম আমি
here.
একটু বলি,
Yes.
এটা প্লাস হওয়ার কারণ হচ্ছে যখন আমি এটা দিয়ে দিচ্ছি এটা আমার জন্য অ্যাকাউন্ট রিসিভেবল হয়ে যাচ্ছে, এই জন্য এটা প্লাস হয়ে যাচ্ছে এখানে, আর এখানে একটা লোনস লেখা।
Look, এখানে কিন্তু loans লেখা, right? If you look at this third, I think this is the third T account or the fourth. Wait, this is the first, second, third. Yes, this is the third T account. Look at the third T account. Here you see this is loans 900. This is not reserves. Okay, so loan, like she has mentioned, loan is accounts payable, right? So asset is basically what you are going to get. So the bank will receive this loan. This loan is the bank's money, right?
Yes.
Jenny has to return this money. So that's why it is plus 900. This is a
Okay,
positive
ma'am.
thing for the bank. Okay.
Okay, ma'am.
Okay. This is I know this is difficult to understand now if you have not done accounting 101. Okay. T account এভাবেই measure করা হয়. Okay. At first even I would not understand, so don't worry. But is it clear now?
Yes,
Yeah,
ma'am.
ma'am. Yes, ma'am.
Yes. Okay. Okay, if this is clear, let's move on to the next slide.
Yes, ma'am.
Okay. Now, before we continue, notice that the money supply has increased. When Jenny borrowed $900 from Bank A and the bank put that amount in her checking account, no one else in the economy had any less money, and Jenny had more than before. Consequently, the money supply has increased. Through the lending activity of the bank, checkable deposits have increased by $900, with no change in the amount of currency or traveler's check. M1 has increased. So you see, if you go back to the previous one, you had only $1,000, right? But from this $1,000, through the process of giving out loans, you have actually created 900 more dollars just by giving out this $900 as loan. Because the bank gave out 900 taka as a loan, now the amount of money has increased by $900 in the economy. Because you see, if you consider this situation, Jenny is someone who did not have 900 taka before, right? But because the bank has given it to her, now she has 900 taka. So in the entire economy, 900 taka has increased. Is this clear?
Yes,
Yes,
ma'am.
ma'am. Exactly, this was my question. Yes, ma'am.
Okay, good. Okay. Now let's move on. Let's continue with the story. Okay. Now suppose that Jenny spends $900 on a new computer. Now remember, previous to this, Jenny did not take out the money from the bank. It was still there in her checking account. Okay. But now she needs to withdraw the money because she wants to buy a computer with $900. She writes a $900 check to the computer retailer, to the computer shop or whatever, who deposits the full amount of the check in bank B. Now imagine there is a new bank. Okay, it's called bank B. So the story is this: Jenny, she writes a check of $900 and she pays it to the computer shop. Okay, and the computer shop owner, he takes this money and he deposits that amount of money in a new bank, in his own account in the new bank, bank B. Is this story clear? Okay. Now we need to see what is going to happen to bank A. First, let us see what happens to bank A. It uses its extra excess reserves to honor Jenny's check. And when bank B presents it and simultaneously reduces her checking account balance from 900 to 0. So let us look at the T account one more time. Look at the assets part. So remember, required reserves is always there. $100, it was always there. It will always be there. But now, excess reserves is 0. Because remember, Jenny has taken out this money from her account and she had to give it to the computer shop owner, right? So now no longer the bank has this excess reserves. It's 0. There's no change. Okay? Excess reserves, 0. Loans. Remember, the bank has given the loan to Jenny. So this is a sort of a money that it is owed to the bank. So loans is obviously plus 900 like before. Nothing has changed here. The change that happened is in the excess reserves portion. Okay, the excess reserve is now 0. If you look at liabilities of the bank, checkable deposits, remember Bill, he deposited $100,000. So it's still there, right? However, if you look at the checkable deposits part, Jenny no longer has any money in the account because remember, she took out all the money. She no longer has any money in her account. So this is 0. Okay. So look, assets and liabilities, did the balance? Are they the same? Yes. Always in the T account, they should always be the same. Okay. So you see 100 plus 900 is 1000 and 1000 plus 0 is 1000. So both sides are now again same, balanced. So from here, the excess reserves became 0 and here the checkable deposits became 0. Why? Because Jenny actually withdraw that money from her account. And where did she get that money? She got that money from bank A. And from where did bank A have the $900? From the excess reserves. Therefore, no longer you have $900 here. Okay? And why did this become 0? This became 0 because no longer in her account there is no longer $900 because she already took it out. So now it becomes 0. So is this part clear? Is this is this T account clear?
Yes, ma'am.
Okay. And we are almost to the end of the whole story. Okay, so bear with me a little bit more. So if you look here, the situation for bank B, now we are going to look at bank B. Okay, bank A is done. Okay, bank A is done. See, back your balance is back to 1000. But let's see what happens to bank B. Because of the computer retailer's deposit, bank B now has $900 that it didn't have previously. This increases the bank B's reserves and liabilities by 900. So this is the bank B's T account. So assets, it has the reserves have increased by 900, because remember 900 taka has been deposited in this bank, and the computer retailer in his or her account 900 taka has been deposited. Therefore liabilities is plus 900. Note that the computer purchase. Okay, I think our time is up, right? Yeah, I think our time is up.
Yes, ma'am.
Would you mind if I take another 5 minutes?
No, ma'am.
Okay, so let's.
Ma'am, I have a class right now. I
Oh,
have
okay.
another class.
Okay. So actually, let's stop here then. We just have a little bit left. We can do it in the next class. Okay. So
Okay,
let's
ma'am.
end here. Those who have a class now, you can leave immediately. That's the end of the lecture today. Okay. And the rest of you, do you have any question? If you have any question, you can actually ask now, or else you can ask it in the next class if you want. Okay. So hopefully there's no question. If you have any
ম্যাম
question, yes, yes.
স্লাইডটা কি দিয়ে দিবেন?
I've already given it to you in Google Classroom.
ওকে ম্যাম।
Okay. So in the next class, that is this coming Thursday, we'll meet again at 9 a.m. Okay. And in the meantime, if you have any questions, you can definitely email me. Okay. And I'll try to answer. Okay. All right then. Okay. So all of you take care.